What's up guys, Jake here. In today's video, we're going to continue talking about trading options and specifically the options trading strategy of selling cash secured puts. And in the event you haven't seen my previous videos on trading options, I will include the playlist down below so you can check it out. And selling cash secured puts, it can be confusing to new option traders, but think of it like this. You have the opportunity to write a contract that will let you buy a stock that you want to buy at a price you're willing to pay for it. Somebody's going to pay you money to do something that ideally you want to do anyways. And in previous videos on my channel, I have stated that selling puts is a bullish strategy. You want to sell puts if you think the stock price is going up. Once again, that's an oversimplification. You can sell puts for more reasons than just that. And ideally, if the stock is going up, it's kind of contradictory, but if you think the stock is going up, why not just buy it? However, selling puts allows you to enter a position that you want to hold potentially long term. So there's two ways to play selling cash secured puts. One, you just want to collect the premium, or one, you think a stock, in the near future is going to be doing well, and you're looking for a good price to enter it because you want to buy that stock anyways. So let's go through my list of things I want you to know before you sell cash secured puts, and then we'll do a couple examples. The first one is, whatever company you sell a cash secured put on, make sure that you're comfortable owning 100 shares of that company. Pick a good company. Do not sell cash secured puts on companies that you don't want to own 100 shares of. So do your research, pick good companies, and recognize that once you sell the put contract, you're putting up collateral. You're losing buying power in your brokerage account. Your broker, whoever that might be, is keeping track of how much you've promised to buy after selling a put contract. So whatever the strike price is, multiply by 100, you're going to lose that buying power in your accounts because, once again, your broker has to be sure that you can actually buy those 100 shares at the expiration date. Number 3 is contradictory, but you need to be comfortable not buying 100 shares of this stock. So when you sell the cash secured put, you lock up the collateral, you lock up the buying power, and you're not actually purchasing the stock. So if you are bullish on this stock, if you think the price is going to take off or go up, it might do that in the period that you sold the put. Maybe you were just hoping to buy it a little bit lower than it is today, and you weren't able to because you locked up that collateral on the contract. So if the share price of the stock takes off, while you were hoping to buy it just a little bit lower than today, you have to be comfortable not owning 100 shares of that stock. So for selling cash secured puts, there's only 2 outcomes. Let's go through them. The first one is the stock does not go below the strike price for the option contract. This is the price you chose, the price you're comfortable buying the stock at. And you do not buy the stock because the contract expires worthless out of the money. You keep the premium. So congrats, you made money on the option contract. The second outcome is the stock does go below your strike price, and you have to buy the stock for the agreed upon price, and you still get to collect that premium. For selling the contract, you make the money on the premium for the contract regardless. However, you can think of option 2 or outcome 2 as still a win. If, once again, this is stock you're comfortable holding, you got the stock you wanted at the price you wanted. So before we do a comprehensive example, let me just demonstrate the risk to you of selling cash secured puts. So this is my brokerage account with Charles Schwab, and I currently have a put sold on a company called Regions Financial. The share price is currently $21.44, and I sold a contract that expires this month with a strike price of $21. So what this means is Schwab is keeping track of this, and I've locked up $2,100 worth of collateral, worth of buying power should this contract be exercised. Now, what was I paid for selling this put contract? And I was paid $84.35 from the buyer. I purchased this maybe a week or 2 ago, and the current value of the contract is $30. So I can actually buy to close this position and make my $54 profit. However, when you sell puts, the max gain or loss you can make is 100%. So if you're paid a premium, $84.35, the most I can make on this option contract is $84.35. The contract at expiration is out of the money. It becomes worthless. The market value goes to $0. Max benefit is 100%. But what is my max downside? And hypothetically, theoretically, my max downside is negative 2,489%. How do you calculate that? Well, let's say that before March 19th, Regions Financial goes bankrupt and the share price of the company goes to $0. At expiration date, I still have to buy 100 shares of the stock for $2,100. So if I only received in premium $84 and then I end up buying 100 shares for $2,100 that are worth $0, my downside is 2,489%. Is that likely? No, it's not likely that Regions Financial in the next week will go bankrupt and I will be out basically $2,016. But it is the theoretical maximum downside, and it's something you need to consider when choosing what companies you're going to sell secured puts on. So let's do a full example on selling a put on the company Verizon. The current share price is exactly $56. When you look at their stock chart over the last 6 months, it goes up, it goes down, but it mostly trades sideways in this range. And it's actually nice, once again, to sell covered calls or sell cash secured puts on reliable dividend stocks that just kind of trade sideways because you're less likely to be assigned. So it's between this $45 and $60 range over the last 5 years. However, it was in a downtrend since December, and maybe you think it's turning around. Maybe you don't want to buy the stock, but you're not worried about buying the stock, and you think this is a good time to sell a cash secured put on Verizon because you don't think it's going to go any lower. Here's the option chain for Charles Schwab, whoever your broker is. It'll look slightly different, and we have the calls here on the left, the puts here on the right. These are contracts that expire in 33 days on April 9th. If you want to simplify it, you can go to the drop-down menu and look at just the puts. In the left-hand column, this is the strike price. This is what you're agreeing to pay for 100 shares of Verizon. And the buyers are bidding these prices, the sellers are asking here. The last is what we can use as our numbers for our example. So $56 is exactly at the money. Contracts with a strike price above 56 are already in the money, and below 56 are out of the money. So when looking at these premium prices, what you're going to be paid for selling a put, you need to remember there's intrinsic value, which is the difference between the share price and the strike price, and then extrinsic value, which is theta decay, time value, plus implied volatility. So when we look at contracts that are currently out of the money, they have no intrinsic value. They can't be exercised today. So this amount you're being paid is 100% extrinsic value, time value, and implied volatility. So when deciding, well, which contract do I sell? How do I determine which strike price to use? It might be useful to reference delta. If you can find the Greeks on your broker's platform, it might be useful to look at puts. And the delta for puts are always between 0 and -1, and it kind of gives an estimate of the probability of the contract expiring in the money. And when I look at the Greeks on Schwab's platform, I can see delta listed in this column here. So if I chose a strike price of 56 when the share price is currently 56, I'm getting a delta value of -0.5, meaning there's a 50-50 chance that this contract will expire in the money by expiration, and then I will be assigned. I will have to purchase 100 shares from this other person for $56. So when selling cash secured puts, you don't want to get assigned every time. So in my opinion, the sweet spot is to sell a cash secured put with a delta value of about 30%, meaning 70% of the time you won't be assigned. You won't have to buy the 100 shares, and 30% of the time you will have to be assigned the shares. But you're always getting paid the premium for the contract you sold. So how much money would you make for selling a cash secured put with a strike price of $54? And according to the option chain, the last agreed upon price was 0.8. So you multiply by 100 and you would be paid $80 for selling this cash secured put. That's your money, goes into your account. It's your money to keep forever. So let's say that we selected the put contract with the expiration date in 33 days at the strike price of $54. So currently it's at 56, strike price of 54. And the premium I'm being paid is 80 cents for the contract, or multiply by $180. To determine your break-even price, you take the strike price and subtract the premium you were paid. So the share price of Verizon has to get below $53.20 before I start losing value. However, it only has to get below 54 before it's in the money and I'll be assigned. But what happens if by expiration date, Verizon stock shoots up? It goes up to $60. The contract expires worthless, you get to keep the premium, you're not assigned, you don't buy the 100 shares. Same thing if Verizon stock just trades sideways. If it just continues trading at $56, then once again, I'm not assigned, I don't have to buy the stock, I keep the premium. And what if it gets down almost to the strike price? It goes down to, let's say, $54.10. Once again, out of the money at expiration, I'm not assigned, I just keep the premium. And according to that delta value, 70% of the time, this should happen. So people like selling cash secured puts on stable blue chip companies to earn extra income. So how much income can you make selling cash secured puts? So you got a premium price of $80, and on the capital, on the collateral that you secured to do this, it was $5,400. So if you made $80 on $5,400 worth of collateral locked up in your brokerage account, you made 1.5% in a month. If you sold a cash secured put with success for every month out of the year, then selling cash secured puts on Verizon stock can earn you 17.7% a year. Now, of course, 17.7% is a best case scenario. According to that delta value, 30% of the time you will be assigned. However, that doesn't mean 30% of the time you were below your break-even price. It just means that the contract was in the money. And ideally, even when you were assigned, you bought a stock that you wanted to buy anyways. If you're comfortable holding Verizon, it does, go up and down. So maybe you're comfortable just holding the 100 shares until the share price goes back up a little bit above your cost basis. And then once again, you just continue selling cash secured puts for income. So that was the first outcome of the contract expiring worthless and you just keep the premium. Let's go ahead and explore what would happen if the share price goes below the strike price for the contract and you are assigned the 100 shares. So let's think about this. What if the stock price goes down to $52 and the strike price you wrote for the contract is $54? So the contract expired in the money. In this scenario, you're going to be assigned. You're going to have to buy 100 shares of Verizon stock from this other person for $54 a share. So you paid $5,400 to this other individual. However, remember, you were paid when you sold the contract $80. So you net paid to take this position of 100 shares in Verizon $5,320. Now the stock went down to $52 per share. The stock is only worth $5,200. So you lost in value net between what you paid and what the stock is worth now. You're down $120 in value. But once again, ideally, you don't care. Ideally, this is 100 shares of a company you're fine holding. You think it's going to go back up in the near future. Potentially, there's an ex-dividend date coming up and you're about to collect the dividend for a dividend stock you wanted to be holding anyways. So, as long as you're selling secure puts on good companies, you shouldn't mind holding the stock, buying it at a discount. It's currently at 56 and you bought it at 52 in a couple weeks or in a month, so that's still a good deal. So let me give you some tips on selling cash secured puts if you're serious about doing this. And the first one is to sell put contracts mostly 1 or 2 months out. The reason why is because of theta decay. The value of the contract will precipitously drop once you're within that 30-day window. So if you sell farther out contracts, you're not capturing as much theta decay, which is where you're making most of your money on the premium. Additionally, if you reference the Greeks for the option contract, you can check implied volatility. When implied volatility is high, anything over 40 in my opinion is higher, you're getting more money for selling that put contract. When IV is low, 20s or less, you're not getting as good of a value. So referencing implied volatility and selling put contracts when IV is high, you're more likely to get paid a better price for your contract. Tip number 3 we already talked about, and this is selling contracts with a delta value of about 30%. This gives you a good probability of not always being assigned when selling a cash secured put. However, occasionally you will still be assigned, and it's up to you if you want to then hold the stock for a certain amount of time or sell it and then sell another cash secured put after that. Tip number 4 is to watch out for ex-dividend dates. If you sell a cash secured put and it expires just before an ex-dividend date, then if you are assigned the 100 shares, you can capture that ex-dividend date to earn an extra bit of income on your cost basis. Tip number 5 is to monitor how much you've made on your cost basis for selling that put contract. What I mean by this is we talked about it. The most you can make on your position is 100%. So if you've already captured 80% of the value of your put contract, let's say in 2 weeks, you sold a 1 month and you captured 80% in 2 weeks, you might want to consider buying to close. The reason why is because you lock in your profit. Let's say the share price shoots up, the value of the contract goes down to 20%, you're up 80% on your cost basis. The share price can still move. So if it all of a sudden starts going down, then how much you've captured on your premium also will go down. So buying to close locks in the profit. It then frees up your collateral, your buying power, to sell another cash secured put. You can extend it going out another month and then once again keep capturing that theta decay. So if you can successfully do this every 2 weeks, then you're not limited to just selling 12 1-month contracts in a year. You can get more frequency to earn more income on selling cash secured puts. Okay guys, that was a lot of information. Once again, people love selling cash secured puts to generate income, and they do this on stocks that they're comfortable buying at a price they're willing to pay for it anyways. That really should be the winning strategy when selling cash secured puts. Okay guys, if you enjoyed this video, give me a thumbs up so the algorithm knows it's good. In addition, subscribe to my channel if you haven't already. I talk a lot about finance and investing topics. If you have any questions or comments, or I made a mistake in this presentation, let me know in a comment down below and I will help you out. Till the next video, take care.